What's up guys, Spencer from Gray Capital, and we are talking about some tips and tricks today that are going to help you as a multifamily investor. Some of these are going to be really kind of hacks for the limited partners out there, passive investors. Also some tips for active syndicators as well. If you were at all interested in multifamily investing, multifamily apartments, you're not going to want to miss this. All right, let's get into the first one. First, we just have to say none of this is financial advice, none of this is legal advice or accounting advice. Consult your own professionals. This is just some real estate education, some things that we think are important that you should know, but only take it as seriously as you'd like, and always consult with your professionals. Okay, let's actually get into it. If you have ever invested or looked at investing into a real estate syndication, a private placement, often those types of investments have minimums. Oftentimes they're $50,000. They could be all the way up to $500,000. So let's say you're an investor, you've got some cash, but maybe you've only got $30,000 you want to invest. You don't have a full 50. How do you still participate with the sponsor that you want to invest with if you don't have that full minimum? Let's say it's $50,000. Well, here is one quick way that you can alleviate that. So how do we invest less than the minimum? Again, those minimums are often $50,000 or more. So let's assume that's $50,000 minimum. How do I invest less than $50,000? Well, one way that you can do this, and we've had quite a few investors in our projects do this, and we don't have a problem with it at all, is you form an LLC with a friend, with your family member, somebody that somebody hopefully you actually want to partner with, and you bring $25,000. They'll invest $25,000 into this newly formed LLC, and then that LLC invests in that syndication, meeting the minimum investment threshold. You could even do this with more than just a single partner. You could do this with 5 individuals all investing just $10,000. So you can only invest $10,000, but you still meet that $50,000 minimum. This is great for folks that maybe not have hundreds of thousands of dollars to invest in multifamily syndication, but they still want to diversify across multiple deals, multiple operators, possibly in multiple geographic regions or locations and markets, but you only have so much to invest. So if you only have $50,000 total to invest, you want to invest in 5 deals, 10 grand in each deal, well, find 5 partners who also want to do the same thing as you, form that LLC, you're going to need an attorney to do it, and participate in those deals. We all know that real estate has a ton of incredible tax benefits compared to investing in other asset classes. But syndications, when you're investing as a limited partner or even as a GP, it's very hard to 1031 or like-kind exchange from that syndication into a new project or new property. And so that leaves many wondering, well, shouldn't I just do my own direct project so I can take the full benefit of a 1031 exchange, which is, if you don't know what a 1031 exchange is, you can essentially defer that capital gains tax, kicking the can down the road. But there is a strategy. While it's not as good as a 1031 exchange, it gives a lot of the same tax benefits and enables you to kind of defer that capital gains liability. So deferring taxes without a 1031, the way to do this is essentially to continue to invest in properties and utilize the massive amounts of accelerated depreciation and passive losses that you can harness via a cost segregation study, which is something that we'll talk about in just a second. By accumulating all of those losses and accelerating them into the first year of ownership, you can greatly offset your capital gains liability from the property you just sold to the new investment. So it works like this. So when you're looking to sell a property, and this may be outside of your control because maybe you're the sponsor or the GP is looking to sell the property, if you roll those funds or invest into another property that same year, and it doesn't have to be the same funds, it's really as long as you invest into a new property that is going to have a full cost segregation study done in that year, you will be able to typically see passive losses equaling 50 to 75% of that initial investment. So if you invest $100,000, that's $75,000 potentially that comes back to you as a passive loss that you can use to offset other gains in that same tax year. So you want to make sure that your sponsor or operator is doing cost segregation studies, and you're going to be getting that full amount of depreciation to the limited partner, in that first year of ownership. Okay, so let's say that you want to diversify. You've got $50,000, but you don't want to go through the exercise of finding 5 different partners and 5 different sponsors, 5 different deals. That's a lot of work, and sometimes it's worth it, but sometimes it's just not worth the time. So how do you get instantly diversified across multiple multifamily assets with one investment? So one way you can do that is through a fund. Now, some people like funds, some people don't like funds. This isn't to get into that debate, but one of the benefits of investing into a fund is that typically you're going to be allocated across multiple assets that are cash flowing or that they're going to be queued up for development. But the key is you're going to be diversified across multiple assets instead of just one asset or property. So instead of investing $50,000 into a syndication and buying one property, you invest $50,000 into a fund that goes out and buys maybe 5, 10, 15 different properties that you're completely diversified across. Fourth multifamily hack, and this is key. Now this is mostly for operators, sponsors, but if you are a limited partner, you want to ask your sponsor, the syndicator, to make sure they're doing a cost seg study or cost segregation analysis or cost segregation study. This is an engineering study that is done in part with your CPA, and it's essentially cataloging every single component of a property in order to depreciate it. And the idea is to maximize the amount of paper losses you can use to offset any potential tax liability, whether that's income tax or capital gains tax. So again, you can get good losses without this, but you will maximize your passive losses through a cost segregation study. So if you're an operator, make sure you're doing the cost seg study. And if you are a passive investor, make sure the sponsor that you're working with is doing a cost segregation analysis. I'm gonna have to make a little bit of room here. But so the fifth hack I want to talk about is these A and B shares. Now this is for operators as well as limited partners. There's certain advantages of having A and B shares. This is something that we don't do at Gray Capital. But there's a reason why other operators do it, and so I want to just kind of get into that and the advantages, disadvantages, and how you as a limited partner can kind of use these A and B shares to really customize your return profile. But then as a syndicator, how you can think about this concept in order to engineer your returns. So essentially, these A and B shares work. How they work is that there's certain rights and preferences given to the A shares or B shares of a company. Typically these A shares, and this is just a rough example, but this is typically what you see, A shares are going to have a 10% preferred return with no upside. So no 70-30, 60-40, it's zero. You're getting your 10% preferred return, typically distributed monthly, quarterly as cash flow. Well, the B shares, they're going to receive, let's call it a 6 or 7% preferred return, and then let's say a 70-30 split. But the B shares don't distribute. The pref isn't distributed. It's accrued until a capital event occurs. And the way that this works in the capital stack, again, typically you have 20% A shares and 80% B shares. So again, the B shares, they're not throwing off any cash to investors. It's being accrued. So 100% of the cash flow is going to fill this 10% preferred return payment to the Class A shares. Now, when the project is actually sold or a capital event occurs, whether this is a fund or single asset project, since the A shares don't have any upside, all of the cash flow first goes to satisfy the B shares, accrued 7% preferred return, and then the 70% of their upside in the waterfall itself. So as a passive investor, how do you utilize this? Because a lot of people think this is confusing and it's frustrating because, okay, I've got 10% here, great, who doesn't like 10% annualized cash flow, but I get no upside. Or I get 7%, but I get no cash flow, but I'm getting a decent amount of upside. So the hack here is, not just investing in A shares or B shares, but doing a combination. Really engineering your own return profile, utilizing a portion of A shares and a portion of B shares. So you're going to be getting a 10% pref cash flow while you hold the investment, but then you're gonna have another 7% accruing and getting 70-30 upside once the project actually sells itself. So now, as a syndicator, as a sponsor, how do you utilize this? The reason why sponsors and syndicators often use this model, or are doing it more frequently now, is that it has a lot of flexibility, and you can actually end up doing projects that are worth doing, but maybe the cash flow is relatively light, because it can take a decent amount of cash flow to meet a 7% preferred return hurdle if the entire investor group is all owed that 7% preferred return. Now, while 10% is high, it's only 10% for 20% of the equity. That means 80% of the equity that isn't receiving cash flows, that cash flow can be used to fulfill that 10%. And so you're really only needing 10% on 20% of the equity, which is a much smaller amount of the overall free operating cash flow than if 100% of limited partners were having cash distributed to them on a regular basis. So this allows an operator to do, call it skinnier deals sometimes, maybe be able to get a little bit more aggressive. And not necessarily that they're bad deals or they're riskier deals, it's just some projects may just have lower cash flow. Maybe it's only cash on cashing, 4 to 6%, and that doesn't meet your specific return hurdles or your return criteria. But if it's enough cash flow to satisfy this 10% preferred return, and you have enough B shares who are okay getting the upside and deferring that, well, maybe you have an actual deal that will work. It's it's just a form of financial engineering. It doesn't actually change the real estate, the project, but having the right deal structure that aligns interests and that everyone is satisfied with that structure, it's a good option to have, and it's another tool to have in the toolbox, and want everyone to be aware of it. Okay, guys, number 6. Now this is a little wonky. Entity sales or drop and swaps, kind of the same concept. Now this won't be applicable in every state, but this is all about deferring tax reassessment for property taxes in your local market itself. We use this all the time in the state of Indiana, where Indiana does not pursue property tax reassessments as aggressively as many other states. Actually, by statute, the state of Indiana can't aggressively pursue sales and try to reassess properties. Some states that they can. So what an entity sale or a drop and swap sale is the idea is to mask, conceal, and to not disclose that purchase price, so it's less evidence, and it's removing a data point for an assessor to look at to try to reassess that property. So the idea here is, instead of actually purchasing the real estate itself, property at 123 Main Street, instead we're going to be purchasing the entity that owns that real estate. So, because typically real estate is owned by an LLC, and so instead of entering into a purchase and sale agreement, we'd be entering into a purchase for membership interest. We'd basically be buying out that membership interest in that LLC, and so the transaction is really about buying an entity and a company rather than the actual property itself. Another version of kind of an entity sale is a drop and swap, where instead of actually buying the entity that owner has been using, you actually create a new entity. The seller deeds the property to that newly formed entity prior to sale, and then the buyer purchased that newly formed entity. The reason why people use the drop and swap as opposed to just a pure entity sale is that entity could have some baggage associated with it. If someone all of a sudden sues that entity from something that happened 2 years ago, you don't all of a sudden want to be on the hook because you're using the last owner's entity. So doing this drop and swap, using a fresh entity that they drop in, and then you purchase that entity from, just one way to potentially kind of defer that tax reassessment, which can be huge for a multifamily investment. Okay, the final multifamily investing hack, and this is something that a lot of people talk about. We've talked about it. We've done a lot of these. It's really one of the ways we got started, but it's doing co-GP. Now, not everyone will be able to do a co-GP because, one, they may not have the means, they may not have the time, but essentially being a co-GP or a co-sponsor on a project is that not only are you, participating in the project in some way, maybe monetarily, you're working on the project, but you have a piece of that general partnership or the management company that receives the promoted interest or, kind of the upside, that 30% in that 70-30 split from the project itself. So you're getting some of the compensation that is issued to the sponsor. And this can come from a variety of ways. Maybe that it's a true joint venture. Maybe you found the project itself and you're bringing in an operating partner and you're splitting that general partnership entity or those percentages. Or maybe you are a capital raiser and you're bringing in a significant portion of the equity to that project for an operator. And so you're going to get a position in a percentage of ownership to that general partnership group. And also, if you just are a high net worth individual, you've got a lot of cash, maybe you've got an extra $1 million burning a hole in your bank account. You could potentially form a relationship with an operator, make a large co-investment, and receive a portion of that GP entity. What ends up happening is your returns are accelerated, because not only are you going to get the returns from your limited partner stake, if you're going to invest that cash, it's typically treated as the same as a limited partner, so you're going to get your preferred return in that 70% or whatever the upside may be. But you're also going to get that 30% or the GP's interest as well, or whatever your percentage of that is. And so what that could do is take whatever return you may be getting, it's going to accelerate it. So maybe you would see a 15% IRR as a limited partner. Maybe if you've got a portion of the GP, that IRR turns in from 15%, maybe you're getting an 18% or a 20%. It all kind of depends on your portion or your ownership of that GP entity. But I can tell you, depending on how active or passive you want to be, this can be a really great sweet spot of not having to take on all the responsibilities and liabilities of being a full-on operator and running a real estate investing business and a syndication company, because this is a business and you have to have a team and staff to actually run this appropriately. But it allows you to run relatively streamlined without a lot of overhead. You're making allocations, you're getting that percentage of the GP, you're getting GP level returns without having all the infrastructure that a typical GP or sponsor needs, and can be this really nice balance of active and passive. Because you're relatively passive, but you still will probably have some ongoing occasional role inside that GP group for your percentage of ownership. You probably can't read any of this because my handwriting is so horrible, but I hope you at least were able to maybe take some notes. You remembered some of this. We've done most of this. We haven't done the A/B shares. We've got some level of experience and all the rest of this stuff here at Great Capital. If you are at all interested in learning more, we'd love to have a conversation with you. You can hop on over to greatcapitalllc.com, so you can sign up, join our investment club, sign up for our newsletter, have an investment strategy session with us. We'd love to get in touch with you and see who you are and what we can do together. But give this video a like, subscribe to the Great Capital YouTube channel. If you have any comments or questions, put those below, and look out for the next video from Great Capital. All right, I'm Spencer Gray, president of Great Capital. Have a good one.